You hear about private equity all the time, right? These kind of mysterious firms buying up companies left and right. And you always have to wonder, why that one? What on earth do they see? Well, today, we're going to crack open that playbook. We're going to find out exactly what makes a company the perfect target. Let's get into it.
So let's just jump right in with a big question. Think about the company you work for, or maybe one you've started yourself. Could it be a PE target? It's a fascinating question, and by the time we're done here, you'll be able to look at pretty much any business and see exactly what a PE investor sees. Okay, so first things first, the private equity playbook. At its core, it's super simple. Buy a company, improve it, and then sell it for a profit. Buy, improve, sell. Easy, right? Well, not exactly. The real magic, the part where they either make a fortune or lose their shirt, is all in what they choose to buy. See, you gotta understand, PE firms aren't just sitting back and collecting dividend checks. No way. They are active managers. They get their hands dirty, and they have two main tools to get the job done. The first is leverage, which is really just a fancy way of saying they use a ton of borrowed money. The second, super intense hands-on management to totally transform the business from the inside out.
Honestly, the best way to wrap your head around this whole thing is to think of it like flipping a house. You know, like on those TV shows? A PE firm isn't shopping for a turnkey, perfect mansion. That's boring. They're looking for that solid house in a great neighborhood that has, good bones, but maybe a dated kitchen or an unfinished basement. The kind of place where a little work can add a ton of value.
So, how do they even afford to buy this house in the first place? Well, this is where that leverage comes in. It's a strategy called a leveraged buyout, or LBO. And it's kind of wild. They use a huge amount of borrowed money, debt, to buy the company. And get this, they often use the company's own assets as collateral for the loan. Which means, and this is the absolute key, the company they just bought has to make enough money on its own to pay back the very loan that was used to buy it. And that right there brings us to the absolute foundation of the entire private equity model. The one thing that is completely 100% non-negotiable. And that is predictable cash flow. Yep, strong, predictable cash flow. You can forget everything else we talk about today, but remember this. If a company doesn't have a steady stream of cash coming in the door, a PE firm won't even look at it. It is, without a doubt, priority number one. It's not even close. So why the obsession with cash flow? It all goes back to that LBO. Remember all that debt they took on to buy the company? That's not free money. It has to be paid back with interest. And the only money available to pay it back is the money the company itself generates. That steady, reliable profit, that's the cash flow. Without it, the entire house of cards just collapses. So when we talk about good bones in a company, what does that actually mean? Well, PE investors are looking for things like recurring revenue, think subscription models, service contracts, money that comes in month after month like clockwork. They want to see a long history of being profitable. And they look for something called high-quality earnings, which basically means profits they can count on, not some lucky one-time sale. Okay, so the foundation is solid. The cash flow is there. Now comes the fun part, the renovation. This is where the real value gets created. This is the potential. Generally, PE firms have two main paths to creating value. Think of it like this. They can either fix the inside, making the business they already have run better and more profitably, or they can grow the outside, literally making the business bigger. Let's break down both. So, fixing the inside. In our house analogy, this is like renovating the kitchen or upgrading the bathrooms. It's all about finding and eliminating waste. PE firms are experts at this. They'll come in, analyze everything, and start optimizing. They'll cut unnecessary spending, streamline operations to squeeze more profit out of every single sale, and put in really tight financial controls. But here's the thing. You can only cut costs so much, right? To really, really boost the value of that house, you gotta add something new. Maybe build a deck or add a whole new extension. For a business, this means growth. And that can happen a few ways: expanding, innovating, or, and this is a huge one for PE, consolidation. Yeah, let's talk about this consolidation play, because it's a classic. It's often called a roll-up strategy. Here's how it works. A PE firm will find an industry that's really fragmented, with tons of little mom-and-pop shops. They'll buy one of the strongest ones. That's their platform. Then they use that platform company to go out and buy up a bunch of its smaller competitors. They just roll them all up into one big, powerful, super efficient industry leader. All right, so you've got the solid foundation and a plan for renovation.
But there's still a couple of X factors that can make or break the entire deal. It's not just about the numbers, it's also about the people and the place. Think about it. The PE guys aren't the ones swinging the hammers and laying the drywall every day. They need a great general contractor, a builder. In this case, that's a strong, competent management team that's already in place. The PE firm is really betting on these leaders to execute the plan, so they're looking for a team that's proven they know what they're doing. And last but not least, the neighborhood. You know the old saying in real estate? Location, location, location. It's the same here. You could have the most beautifully renovated house in the world, but if it's in a declining neighborhood, you're not getting top dollar. The company has to be in an industry that has what investors call tailwinds, big, powerful trends that are pushing the whole industry forward. So what does a great neighborhood look like in the business world? Well, it means an industry that's pretty resilient to economic downturns. Maybe it's healthcare, benefiting from an aging population, or a tech sector riding a new wave of innovation. It could even be an industry getting a boost from new regulations. All these things make the investment way safer and a heck of a lot more attractive when it's time to sell. Okay, we've covered all the pieces. Let's put it all together now and sketch out the perfect, ideal private equity target.
So if you're ticking the boxes, here's the 5-point checklist. Number 1, strong, predictable cash flow. Can't say it enough. 2, room to make it better. Operational improvements. 3, clear ways to make it bigger. Avenues for growth. 4, a great team already running the show. And 5, favorable industry trends. It's in a great neighborhood.
So to put it all in one sentence, the perfect PE target is basically an under-optimized cash cow run by a fantastic team sitting in a growing industry. It's the ultimate fixer-upper, just waiting for the right buyer to come in and turn it into a showpiece. And that leaves us with one last kind of nagging question, doesn't it? If a company is such a diamond in the rough, with all this potential just sitting there, why doesn't the company just polish itself? Why do they need a private equity firm to come in and do it for them? That is something to chew on.